Hello, fellow compounders. Welcome back. A club member asked, how do you find good investments for your portfolio? How do we come up with the investment ideas? In this video, I'll show you 3 ways that I use, and I'll provide specific examples. This video is for educational purposes only and should not be considered financial advice. I am not your financial advisor, and you are responsible for your own financial decisions. There are 3 ways that I use to find ideas for my dividend portfolio. Number 1, the lazy couch potato way. This involves doing almost nothing and just picking a dividend ETF. I'm not going to bother picking individual names and just buy a basket of dividend paying stocks. I did a video on this, and here's the link. Number 2, the top-down approach. This involves thinking about characteristics I'm looking for and using a stock screener to compile a list. And number 3, the bottom-up approach. Using everyday knowledge, I list companies I know or I'm interested in. Then I research to confirm that the candidate has the characteristics that I'm looking for. Let's take a deeper dive. This is what I do. Number 1, the lazy approach. I just buy SCHD, Schwab's US Dividend Equity ETF. Morningstar gives it a gold rating, and it says that it provides a better risk-adjusted return than the Russell 1000 Value Index. This ETF tracks the Dow Jones US Dividend 100 Index. It is a good blend between high yield and dividend growth. The current dividend yield is around 3.6%, and its expense ratio is 0.06%, 6 basis points. SCHD is a significant position in my portfolio. I use it as my go-to dividend ETF. Whenever I have extra cash lying around and I don't want to do research, I just buy more SCHD. Number 2, the top-down approach. Here's what I do. I define the parameters I want in a dividend stock and I pass it through a screener. These are the parameters. Number 1, I want a return on invested capital to be above 15%. This is a profitability measure. I want to make sure that any profits that are not paid out as dividends are being reinvested back into the business at a good rate. For me, that is 15% or better. Number 2, a return on invested capital 5-year average of 15% or better. If the business can maintain its ROIC average over the past 5 years, it is a good indication that it has a moat or competitive advantage. Number 3, dividend yield is between 1 and 5%. I want dividend that is not too low and not too high either. Dividends less than 1% are negligible, and if they are higher than 5%, they would be high yielders in my book, and that's a different portfolio. I prefer dividend growers, so the sweet spot is between 1 and 5%, and we want consistent dividend growth. So number 4 is consistent dividend growth. In my case, I define it as an average annual growth of 8% or more over the past 5 years. 5, a payout ratio less than 40%. This means that the company is keeping at least 60% of its earnings to reinvest. This is what provides the growth, which will increase future dividends. Number 6, a 5-year earnings per share growth average above 8%. And number 7, 5-year sales growth rate average above 8%. Next, I used StockRover to apply the screen to a universe of stocks, and it came up with a list of stocks that met the criteria. Here's the list. The next step is to review the list and select the stocks I'd like to own in my portfolio. I would go through the list and select a handful of stocks that complement my portfolio and just buy evenly across the list. If I were starting a portfolio from scratch today, out of this list, I would probably pick ConocoPhillips, CLA, Public Storage, PSA, United Healthcare, and Williams-Sonoma. Number 3, the bottom-up approach. This is my favorite approach. It is the most interesting. It is by far the least efficient approach, so it's not for everyone. But to me, it is enjoyable and entertaining. I start by drawing on my interests and experiences. Do you remember Buffett's screen about buying businesses that you understand? This is where we apply it. My bottom-up approach is, number 1, I make a list of things that I'm interested in. Travel, eating out, Tom Clancy novels, football, basketball, martial arts, gaming, the latest technology, investing, real estate, etc. Number 2, I list businesses that I've noticed operate in my areas of interest. For example, in the area of eating out, I list Yum, Starbucks, Papa John's, Domino's, Chipotle, and other eateries. Number 2, military fiction. So out of Tom Clancy novels, I can pick out Lockheed Martin, General Dynamics, Northrop Grumman, and military contractors. Number 3, from football and basketball, I take ESPN, which is Disney, in Madison Square Garden, which is a public company that owns the New York Knicks and the Madison Square Garden. And 4, gaming, I would put in that list Take-Two Interactive and Activision Blizzard. Number 5, tech, I would put Apple, Google, Meta, Microsoft, things that I use regularly. 6, movies, I would do Paramount and Warner Brothers Discovery. Number 7, investing, that's easy. Schwab, Bank of America, JP Morgan, Capital One, American Express. Okay, so 3, I'll apply the screen to the list that we just did and rank them. I'll use Stockrover to do this. When we review the results, we can see I had my entire list and it's scored, and it gives it a score of how they actually compare to my screen, the screen that we used from the top-down approach. So basically the best ones here on the list are Northrop Grumman, Domino's Pizza, American Express, and Microsoft. They got 8 out of 9 parameters. So out of these, I would go for step number 4, which is dig deeper. I would probably select Domino's Pizza because I already have Lockheed Martin in my portfolio. I have financials, and Microsoft is already in my portfolio. So Domino's Pizza is one that I don't know about. So I'm going to go and dig deeper in Domino's Pizza. Let's start looking at the research report of Domino's Pizza provided by Stockrover. We can see here that Domino's has a dividend yield of 1.4%, which is within the range of our typical dividend growth stock. And we can see there's a consensus analyst buy rating. It doesn't really tell me much. We should do our own research. And we continue going down, and we can see let's see here. Sales growth numbers look decent, average of 8% over the past 5 years. And earnings per shares, earnings growth, 13% over the past 5 years. Last year was kind of shy, but remember there was COVID in between. And next year is projecting a 12% growth. That's pretty good. So let's continue. And we're looking at return on invested capital of 60%, 60.9%. That's impressive. That's 3 times more than the industry average and 3 times more than the S&P 500. So that's really amazing. Return on equity is negative. We need to dig more in that, but the reality is that when you look at the balance sheet, they have negative equity. So don't think much of that for now, and we have to find out why that's the case. But I suspect is that probably they depreciated a whole bunch of assets, and given that they're depreciated, they have no assets on their books anymore, and they have debt, so that gives them a negative equity. So as long as they can cover, and they actually have a great business doing a return on invested capital of 15%, that's great. So let's continue. So I wanted to look at the dividends piece. Let's see here. So here's the dividend graph. That looks really nice. Look at that growth of the dividends over time. And here we can see payout ratio of 30.5%, which is below our 40% mark, which is really good. Dividend coverage ratio means that they can cover the dividends 2.9 times. So that's not a problem. You won't have to worry about them canceling the dividend. And this is good. 9 consecutive years of growing dividends, which we already saw in the graph. And we can see that the 10-year growth rate, dividend growth rate, was 19.7%. Great. This is a great, from a historical standpoint, this Domino's Pizza looks like a great dividend growth company. So, you probably need to do some extra research, but overall, from a big picture standpoint, this is an investment that I would consider putting in my portfolio, my dividend growth portfolio. So there you have it. That's my process. If you have any questions, please post them in the comments below, and I'll see you in the next video. Take care.